Welcome to Lesson 3 on money flow. We are going to be looking at money flow as a technical indicator of changes in our market price. We first need to understand what a tick is. Some stock traders follow customized tickers that offer trade-to-trade information. Tick is used whenever there is a change in the price of a share from one trade to the next. We have an uptick if the price is higher than the previous trade. So for example, if I just now traded for a price of $20 per share and the previous trade was 18, we would have an uptick. And a downtick is just the opposite. That would be when the price is lower than the previous day. These tick changes contribute to a type of market analysis known as money flow, which we'll be exploring today. When we have an uptick, that's a positive money flow, and when we have a downtick, it's a negative money flow. Since we're looking at money flow, we'll be tying price and volume together very closely. The money flow index is a momentum indicator that measures the strength of money flowing in and out of a security. Our learning objectives today are to understand terminology surrounding money flow, be able to identify the positive versus negative money flows, and then to calculate typical price, money flow, money ratio, and money flow index. And we'll learn how to do that in a series of steps. We also want to interpret money tops and bottoms as an indicator for change. Let's look at the big picture. Let's look at a little bit of interpretation. Here's one type of interpretation, and it's called divergence. We want to look for divergence between the indicator and the price action. In this chart, the top flow is the indicator, the money flow index, and the bottom chart is the price. If the price tends higher and the money flow index trends lower, we have a divergence. Or, for example, a reversal of that. If the price trends lower and the money flow index trends higher, also a divergence. If we look at this graph and we look at A, you'll notice the red line is going down and the green line is going up. We have a divergence, which indicates that a change is coming. We also can see that in B. Not as steep, but we still have a divergence. While we have B on the top going down, the indicator's going down, the price is going up. We should be careful to maybe perhaps sell because of our indicator. Another type of interpretation is market tops and bottoms, which we'll focus on a little more. We want to look for market tops to occur when the money flow index is above 80, and we want to look for market bottoms to occur when the money flow index is below 20. So you can see from this graph here on the left, here's 20, and when it gets below, we want to buy because we can predict that perhaps the price will start to rise. Same thing when we have a top. When we get above 80, we might want to sell because the market is expected to go down. And if you look at Intel Corp here, over on the right you can see 20. And you'll notice that when the market gets down below 20, it tends to reverse direction. Same thing as when it gets above 80, it tends to reverse direction there as well. Let's go ahead now and calculate our money flow index. In order to calculate it, we need to go through a series of calculations. So this is a very important place where you should definitely take out your notes and write this down. We're going to go through this in 4 steps. The first step is to determine the period's typical price. The typical price is really just an average. It's an average of the day's high, the day's low, and the day's close. So we take the high, the low, and the close, divide by 3, and that gives us our typical price. That's step 1. The second step is to calculate money flow. Not the money flow index yet, just the money flow. And that's simple. It's calculated by multiplying the period's typical price, which we found in step 1, by the volume for that day. That gives us our money flow. One thing to note, if today's typical price is greater than yesterday's typical price, it's considered a positive money flow. On the other hand, if the price is less, that's negative. Step 3, we now need to calculate our money ratio. And we do that by dividing the positive money flow by the negative money flow. Really important to notice here and to star this in your notes. We always put the positive money flow as the numerator and the negative money flow as the denominator. So we need to be careful to notice which is which. And then finally, we can calculate the money flow index. There is an equation for that, and I'll show you that in our example. So we have 4 steps. Make sure you've written down step 1, typical price, step 2, our money flow, step 3, our money ratio, and then we'll look at step 4 when we get to that. All right, here's our example. Step 1, our typical price. Well, here's 5 days, and here's the high, the low, and the close, and this is from Crocs. So I've calculated the typical price by adding these up and dividing by 3. You've practiced doing this already, finding averages, so you should be good at finding the typical price. All right, we've done this for each day. Let's move on to step 2. Now we're going to look at money flow. So here's our typical price from step 1. Now we need to look at the volume. Remember that our money flow is just our typical price times our volume. And that's what I've done here in step 2. If you keep it organized in a type of chart or graph, it's easy to get the steps correct. Now notice that I have a green number here and red numbers here. So take a minute and think about why that might be. Okay, well hopefully what you've done is you've looked at our typical price from one day to the next. Our typical price from day 1 to day 2 went up. So we have a positive money flow. But look what happened from day 2 to day 3. It now went down. Day 3 to day 4 also went down, and day 4 to day 5 went down as well. Therefore, these are all red negative money flows. Let's move on to step 3. Calculate our money flow ratio. So here are our money flows. Now, we need to take the positive flow divided by the negative flow. Again, I'm looking at these prices. $15.30 is greater than $15.10. So I need to put the money flow of 19 million on top and the one of 11 million on the bottom. Positive always goes over negative. This gives me my money flow ratio between those 2 days. And then I'll continue on, and I'll take the next 2 days. And again, notice which money flow is on top. It's the positive one, because $15.30 is more than $15.23. So the 19 million goes on top and the 46 million on the bottom. Moving on to the next day, same thing. Put the positive money flow on the top. And then we'll do it once again for the last piece of data we have. Another thing to note is that our example uses a one-day money flow ratio. We're going from one day to the next. That's not really typical. Typically, this ratio is calculated using multiple days, such as, for example, 14 days. In order to do that, we would take the 14-day positive total, so we would add up all of the money flows that are positive, and we would divide it by that same 14-day negative total. So in this case, we had one positive on the top, and the rest were negative. So we would take the 11 million on top and divide it by the sum of these. But for simplicity's sake and for this lesson, we're just going to go and look from day to day. Let's move on to step 4, the final step. This is calculating our money flow index. And here is the equation that I told you about. Make sure you write this down. It's 100 minus 100 divided by, parentheses, 1 plus our money flow ratio that we just calculated. The only thing difficult about this is that you follow order of operations. So we have to do the parentheses first, and then the division, and then finally the subtraction. So let's look at our first example. I've taken our first money flow ratio of 1.799, and I've plugged it in. So the way I calculated 64.27 is I added 1 to 1.799 to get 2.799. And then I took 100 divided by 2.799, and I took that total and subtracted it from 100. to get my money flow index. I'm going to do one more for you. Here's the next one, 0.423. When I plug that in, I get 29.73. When you're looking at graphs, this is what they're graphing, the money flow index. However, remember, we're doing this on a day-to-day basis, and usually the graphs that you look at will be on a 14-day basis. Let's look at some graphs. Here's Intel Corp again. And you can again see our money flow index on top, and here's all the indicators. In another example, there's a line here at 20 and a line at 80. So you can more clearly see how the money flow index comes up to the ceiling and then bounces back down. It's very rare, as in this example here, for the money flow index to stay above that ceiling for too long. And then notice down here at the bottom, it comes down to around 20, and that usually indicates a change in price. All right, let's summarize our success criteria. So at the end of this lesson, you should understand terminology that's associated with money flow. You should also be able to calculate and have in your notes the 4 steps to finding your first, typical price, second, your money flow using volume, third, the money flow ratio, and finally, the money flow index. Make sure you understand the positive flows versus the negative flows. And finally, understand the market tops and market bottoms as an indicator of change in price.